Hello and welcome. In this section you will learn what technical analysis is and how you can use it in your trading. You will know how to understand different chart types, chart formations and indicators. You will understand the principles of fundamental analysis as well as some of the most important financial data. You will know what a trading journal is and how it can greatly benefit your trading. And you will know how to use risk and money management and why it's so important for your trading. When you are an active investor in the stock market, you are presented with many options and opportunities on how to make financial decisions. But one discipline has been growing in popularity ever since: the so-called technical analysis. Technical analysis is a form of analysis which has the pre-assumption that you can come to conclusions regarding the future of the price by looking at its past. You can analyze a chart with different tools. First of all, you can not only display the development of a share price as a single line. Instead, you can use other ways to illustrate the price movement. Two of the most popular ways to depict the chart are the so-called bar chart and the candlestick chart. The bar chart was developed in the 1950s, simply because there was a need for charts with higher informative value. The bar chart is the graphic display of the opening, high, low, and closing price of a particular time period. For every time unit, a day for example, the highest price of the day is connected with the lowest price of the day with a line. Thus, a bar is drawn. Along this bar, you can add dots, representing the opening price on the left-hand side and the closing price on the right-hand side. Candlestick charts represent a method of charting analysis which has its roots in the 18th century in Japan. In comparison with a bar chart, a candlestick chart shows much more vividly whether the market has moved up or down. The focus of this chart type lies on the informative value of the opening and closing prices. For example, an opening price and a closing price, which are the same level, indicate an indeterminate market and can forecast a change of price direction. Over decades and centuries, an entire library of candlestick formations has been documented. To make assumptions about the further development of the market, you have to look for certain patterns and formations in the chart which had a particular relevance in the past. To do that, you can, for example, draw lines into the chart to highlight important price levels. In this case, we speak of support, resistance, or trend lines. The idea behind most charting patterns is the notion that you want to discover the mass psychological behavior of other market participants. If, for example, euphoria subsides at the end of a strong upward trend, you can interpret this as a change of market direction and discover this sentiment in the chart. Head and shoulder formations indicate a strong trend reversal in the market. They represent an important signal that the primary direction of the market is going to change soon. After a strong upward trend, there can be three distinct highs, with the highest high in the middle. Both so-called shoulders should have the same distance to the head of this formation. The connecting line between the lows is the so-called neckline, and it can sometimes trend slightly up or slightly down. The break of the neckline indicates the completion of the formation and will trigger strong selling activity. To evaluate the effectiveness of a formation, you can look at certain statistics which are available especially for the US stock market. According to one statistic, head and shoulder formations show a success rate of 93%. Let's talk about indicators. All indicators follow mathematical models which can also be graphically displayed in addition to the plain price chart. Most charting software tools offer a wide range of indicators along with their individual explanations. A very simple indicator, for example, is the moving average. This indicator shows a smoothing of the price movement by calculating the average of a predetermined number of historical prices. Fundamental analysis is the classical form of analysis, which is based on facts and figures related to a particular financial instrument. If we analyze a stock, we will not necessarily look at the chart, but instead we will evaluate the corporate data by looking at different financial figures. Both countries and corporations publish official figures on a regular basis. Corporations, for example, publish financial statements, quarterly reports, and ad hoc disclosures. The most important figures give us an idea about the value, profitability, and the growth of a company. The price-earnings ratio is one of the most well-known figures of the fundamental analysis. It is calculated by dividing the stock price by its profit per share. The price-earnings ratio, therefore, shows how often the profit is included in the current share price. As a rule of thumb, you can say that in a stable economic environment, a price-earnings ratio of 10 or below is cheap, and a ratio above 25 can be considered expensive. The price-to-book ratio relates the book value of a company to the current share price. The book value is the value of an asset according to its balance sheet account balance. For assets, the value is based on the original cost of the asset, less any depreciation, amortization, or impairment costs made against the asset. A price-to-book ratio below 1 indicates that the value of the asset is higher than the valuation of the company at the stock market. The price-earnings-to-growth ratio, or PEG ratio, is a growth indicator. To calculate the PEG ratio, the price-earnings ratio is put in relationship to the average long-term growth rate. Typically, investors look at the 3 to 5 year growth prospects. As a rule of thumb, a PEG ratio of below 1 indicates that a share is undervalued, while a PEG ratio of above 1 can be considered overvalued. Let's talk about the trading journal. Do you know what a trading journal is? In a trading journal, you keep a detailed record of all your trades. That means that you will write down when and why you have made the decision to enter and to exit a trade, and what the result of this trade has been. Besides supporting a disciplined behavior, it will also give you the opportunity to evaluate retrospectively all your decisions and discriminate between good and bad trading ideas. Essentially, it will help you to get better and better. Always remember, experience is a very important resource in your trading. This should be part of your trading journal. Why did I open a position? What safeguards and expectations did I have? Why did I close a position? And what did I learn? At the end of a trading week or after a certain number of trades, you should sit down and evaluate your journal entries. Then you should formulate an intermediate conclusion about your experiences. The trading journal will serve you to be more conscious with your trading decisions and enable you to better evaluate your strategy. Let's have a look at two concepts which are essential and indispensable in your trading: risk and money management. Experienced traders realize that these two concepts have a bigger impact on your trading success than your strategies for entries and exits. So what is behind these two terms? Risk management belongs to your trading strategy. It determines when you will exit a position if it doesn't go your way. Thus, it serves to limit your losses by making use of stop orders. Successful traders not only ask when to enter a trade, but they also exactly define when a trading idea has failed and a position has to be closed. Money management, on the other hand, serves to define the appropriate position size. It answers the question, how much? Many traders determine their position size more or less instinctively. In most cases, this will lead to position sizes that are too large and that can do great damage as a result. I will show you a very simple method how you can determine your position size. Let's say you have a trading account funded with 10,000 euros. As a first step, you will define how many % of your account you are prepared to lose per trade. Typically, that amount should be anywhere between 0.5 and 3%. At the beginning, I would advise a more conservative approach. For our example, you decide that you will risk a maximum of 1% of your account per trade. That amounts to 100 euro. You plan to buy a share CFD that currently quotes at 100 euro. In the chart, you can see that the share has tested the 95.50 area several times before changing direction and rising repeatedly. Obviously, we have a solid support at this price level. You decide that this support level is also your stop-loss price, and thus you place a stop order at 95 euros after opening your position at 100 euros. So your initial risk per share CFD is 5 euros. Because you have also defined that your maximum loss should not exceed 100 euros. You divide these 100 euros by 5 euros. As a result, you know that you can buy 20 share CFDs. As you have discovered, the position size is in direct relationship with your risk management. Often both terms get mixed up with each other, but now you know better. While risk management is the part of your trading strategy that defines how you limit your losses, money management will determine the size of your position per trade. Now, in this section, you have learned what technical analysis is and how you can use it for your trading. You have discovered how to use charts, formations, and indicators. You have learned what fundamental analysis is and which financial figures may be important to your trading. You now know what a trading journal is and how to keep one. And you have learned the difference between risk and money management and why both are fundamental to your success.